Hi, everyone, and welcome to the Coastwise webinar. We see some of you are still trickling in, but we're going to get things going. Our goal today is to help you learn how to use options to generate income, provide hedging, and reduce volatility. The topics that we're going to cover are covered calls, buying puts, and selling puts. Of course, we can't cover everything, so we encourage you to submit your questions or contact us afterwards for a free consultation to discuss your specific situation. Also, please note that we are not your financial advisors. As such, any investment information provided is for informational purposes only and should not be deemed as a recommendation to purchase or sell or a solicitation of an offer to buy an interest in any security. My name is Patrick Fisher, and I'm joined here today by my friend and colleague, Scott Kyle, who's the CEO of Coastwise Capital Group.
Hello, everyone.
If you'd like to learn more about Coastwise, please feel free to visit our website, check us out on LinkedIn, our YouTube channel, and you can certainly send us an email or give us a call. We'd love to hear from you. The first part about understanding options before we dive into the specific strategies is to understand the basic terminology of an options chain. I'm going to use the analogy of a concert. And let's say you have 4 tickets to a show coming up later this year, and you can only use 2. So there's a situation where you might want to sell the 2. And in that case, the expiration date is simply the date of the concert. That's sometime in the future, maybe 1 month, maybe 2 months, maybe 3 months. There is the strike price, which is the price that you would agree to sell the tickets. Hopefully that price is higher than your current price. There is the premium that you would actually charge for this option to actually sell the tickets. Then there's the underlying security. In my analogy, of course, that's the concert tickets, but in real life, that would be an equity like Pfizer or Google or Coca-Cola. And then there's the number of contracts. It's important to remember, and we'll get into this in more detail later, that each contract represents 100 shares. So in order to buy and to sell, you have to be willing to sell or to buy 100 shares at least, or a multiple thereof, of the underlying security. As I mentioned, the expiration date is some date in the future where you would have the exercise actually happen, right? So it's possible that the exercise would happen before the expiration date, but after the expiration date, the call option is gone. So in the case of the concert, you would perhaps give somebody the option to buy the tickets before the concert date. The expiration date is the concert date. And certainly after the date of the concert, there's no option to discuss. That being said, the buyer of the option could exercise any time between now and then. The strike price is simply the price that you would be willing to buy or to sell the option if you are selling the option, and or the price that you'd be willing to sell. So it's generally not going to be the same as the actual underlying stock price, but in some cases they are the same depending upon how the stock is moving. The premium is simply the amount of money that you would be willing to part with as a premium to sell the underlying security, and or the amount of premium that you'd be willing to pay for the option to buy or to sell that security at a later date. The underlying security in this example is Apple, though it could be any stock or even in some cases ETFs. The contract, as I mentioned, is almost always going to be in some multiple of 100 shares. So it's important if you get into trading options that you know that you're dealing in multiples of 100 shares. Options chains, which is simply the quotes and gives you the information about the different strike prices, the different expiration dates, and all the information that we've just discussed, come in many shapes and sizes. Most of that has to do with the actual platform that you're trading on, but the fundamentals of what we've just discussed will always be available to you in the options chain.
Great, thank you, Patrick. We're now going to get into what many consider one of the most basic option strategies, and that's called selling covered calls. So it's important to note there are a few objectives or benefits of selling covered calls. One is to generate income, another is to provide a hedge. But remember, you can sell calls all day long and generate lots of income, but you're never going to offset a stock price going to zero. So always do your fundamental research and make sure that you first and foremost buy a high quality company and then look to sell a covered call against that. So let's start out with generating income. So the first step, of course, in selling covered call is to buy the stock long. So let's say, for example, you buy Apple computer and then you sell a call, and that call has a bid and ask of 1585 by 1605. If you buy 100 shares of Apple, then you'd sell one contract. As Patrick mentioned, each contract represents 100 shares. So in this case, the sale of one contract would generate approximately $1,584 of premium, and that cash actually gets credited to your account the moment that you sell the call. However, there is an offsetting position called the short call, which would be the opposite of the cash. So it would be negative 1,584, and those would be the two positions that you have. So this is an example where you buy a stock long, sell a call, and use that as a means to generate income. The other aspect of selling calls is to provide a hedge. As I said before, though, call selling really provides a fairly small hedge depending on how much premium that you generate. And indeed, the hedge is the exact amount of the premium. So in this case, if you own a stock at $100 and you sell a call with 105 strike price that generates $3 per share, then you're hedged down to $97, which is simply the current stock price, 100, minus the options premium that you generated of $3 per share, or 97. So the stock could go to 99, 98, 97, and you're still haven't lost money on that position. But once it goes below 97, the options premium that you generated, $3 per share, is not enough to offset the stock price. So options, the sale of calls, is a good way to provide some hedging, but it's only going to provide a hedge up to the amount of the premium that you've earned from selling that call. As we said before, we're not going to be able to get to everything today. There's a lot that we're covering, but we are offering a free consultation with either Patrick or myself as financial advisors to really discuss anything that you want to discuss further. It can relate to your options. It can relate to your portfolio. So make sure to fill out the Q&A and provide your information, and then we can set up a time to talk to you afterwards about your particular circumstances.
And before we jump into buying call options, let me just remind everyone that you can certainly submit questions in the chat, and we'll be sure to answer those too at the end of the webinar. So buying call options is inherently sort of the opposite of selling a call option, whereas you don't necessarily need to own the underlying stock, and you are speculating or you are bullish on the future stock price. So in this case, you might own Pfizer, you might not own Pfizer, but you are in either case, bullish that the price might go up. So you might speculate on the stock price by buying the calls, and or you might look to have a stock replacement strategy by having a long exposure via buying calls. Now, it's not always the case where the stock price goes up and the option value goes up. There are certainly nuances to that scenario, but generally speaking, when you are buying calls, you're bullish on the stock, and so you're also going to have an option value that goes up as the price of the stock goes up. So let's look at this as stock ownership replacement. In the case on the left, you're going to buy 100 shares of Apple. Let's assume it's trading at 141.64 at present. Your initial investment is $14,000 to buy the 100 shares of Apple. Of course, once you buy that, your gain is unlimited, and your maximum loss is the money that you spent, which is the $14,000. Let's say you either don't have the $14,000 and or you would prefer not to use that money towards actually buying the equities. You could buy one contract, one call option that allows you the option to buy 100 shares at the 140 strike price. Those might be trading at $1.57, in which case you've actually spent $1,500 for the option to buy the stock at a future price, at a future time. Let's look at a slightly more bearish example. Again, we're going to be buying the option, and this is buying the put option. So rather than buying the option to purchase an equity or a security at a future time, buying puts allows you to sell it. So it's a way to provide a hedge, similar but different to selling calls, as Scott discussed earlier, and it's a way to speculate on stock decline. So let's look at an example. Let's say company X is currently trading at $100. You don't want to lose any more than $5, so you buy the January 23s that are the strike price is $95, and you've spent $3 on this option. Again, if the price of the stock goes below 95, you have the option until sometime in January of next year to actually sell it at the guaranteed price of $95. What this means is that your break even is anything below $92, even though you might still, or you probably would, exercise it anywhere below 95 because you're still going to get that incremental dollar amounts between the strike price and the break-even price. This is to say, and again, this is not every single situation, that generally speaking, when you're buying puts, you are bearish on the stock. So if the stock price goes down, the price of the option that you purchased goes up.
Another option strategy that can provide several benefits is that of selling puts. So there are a couple things selling puts can do. First, it can be a great source of income generation. And secondly, it can be a means to buy stocks at a lower price than the current market price. So in terms of generating income, let's say a stock, for example, today is at $100 per share, and you're considering buying it, you'd be willing to own the stock, but you want to use selling puts as a means to generate income. What you do then is you'd sell a contract, for example, for $3 per share at a strike price of 90, such that if the stock were to go below 90, you'd be required to buy the stock. But if it doesn't go below 90, then you don't end up buying the stock. And in either case, you generate $3 per share or contract of income. In this case, it would be $300. So a lot of people use put options as a way to generate incremental income with the possibility of buying stocks, but in some cases, they end up not buying the stock at all. Let's look at a situation where you would end up buying a stock potentially. So here, let's say the stock is currently $100 per share, and you like the company, but you'd rather buy it at even a lower price. So you'd sell the same thing, a $90 strike price, and you'd generate $3 per share of income from selling that option. In this case, your effective purchase price would be $87, which is the strike price of 90 plus the $3 per share of options premium income that you generated, and that would equal $87. So that's a 13% discount to the current market price. So remember, only sell options for stocks for which you think you might want to buy the stock, because you need to be prepared for anything that's possible. You may sell an option that's way out of the money, in other words, well below the current market price, thinking the stock price will never get that low so that you'd be assigned or be required to buy the stocks. But as we've learned with recent market conditions, stocks can go down very quickly in a short period of time. Therefore, only sell puts under situations where you are comfortable owning the stock.
Thanks, Scott. So we've covered a lot of ground today. We've reviewed selling covered calls, buying puts, and selling puts. We're sure many of you have additional questions, so we encourage you to submit them in the chat room. We're also offering additional resources, including a free copy of The Power Curve written by Scott, which allows you to understand how to use smart investing using dividends, options, and the magic of compounding. This book gets into far more detail than we've been able to cover today. For those of you who prefer one-on-one consulting, as Scott mentioned, we offer that on a free basis, a no-obligation 30-minute session with either Scott or myself to review any specific questions that you may have. Thanks again, everyone, for joining us, and we hope that you have a great afternoon and evening.
Thank you.